Welcome everyone. Thank you for attending Langricks webinar today on the changes coming into pension death benefits. We are really lucky to have Becky Williams from Pareto, who supports the delivery of financial planning to our clients, taking today's webinar. So when it comes to questions, we've gone through this today, and it's a really interesting webinar that we're going to go through. Becky and I continued the discussion afterwards, and I'm sure lots of you will have questions. I don't think we'll get time to go through them all today. So any questions that you have at the end of the presentation, please reach out to Becky directly and she will be able to answer them for you. So without further ado, let me pass you over to the amazing Becky.
Good afternoon, everyone, and thanks for the introduction, Fern. I don't quite know what to say about that, but as Fern says, I'm an independent financial advisor. So I work for a company called Pareto, but we help support Langricks clients, and I tend to deal with things like pensions, retirement. I can help support some of the investment content of the inheritance tax planning that Nigel would do at Langricks. And I generally put investment strategies in place for the future. So everything that we do is driven by client objectives. And my job is basically to ensure that people have got enough to financially fund what they want to do. But not a day it's unusual times. Not a day goes by at the moment that I'm not asked about pensions, and that used to not be the case. Most people completely turn off when you talk about pensions and the rules that apply. But rule changes announced in October 2024 have put in significant changes to the tax landscape on death for defined contribution pension schemes, and that is causing quite a lot of concern for the people that I talk to, hence the reason for putting this presentation together. So the idea is, what I'm going to do is explain the rules that apply on death for invested pensions today, what's likely to change from April 2027 following announcements in October 2024, and what the impact might be. But before I move any further forward, it's probably appropriate for me to just make a distinction between the type of pensions I'm actually talking about. So defined contribution pension schemes is a word or a term that we use in the industry to refer to invested pensions. So anything with an investment content is typically categorized as a defined contribution pension scheme, and the rules that I'm talking about today will apply. Defined benefit schemes are completely different types of pensions. They're contractual arrangements between an ex-employer and a member of that scheme, designed to deliver a regular income from a particular date. Whilst those schemes are still in play and still offered to some people, they're not referred to in this presentation. So I'm not going to talk about that type of pension scheme at all today. So I hope that makes sense. So pensions, the current rules that apply on death for pensions are that they do not form part of your estate for inheritance tax purposes. That makes them quite a tax advantageous asset in the event of death currently. And it's particularly advantageous because via a nomination form, which are offered by your pension schemes, you can pass wealth on to whoever you want to pass wealth on to. So it's really simple to fill in a nomination form, and the rules allow you really flexibly to pass wealth down to future generations via your pension. A different set of rules apply as far as tax is concerned to pensions currently than any other asset. So if an invested pension is remaining on death of a member before age 75, The recipients of that pension can inherit it without any tax deduction whatsoever. And the rules allow for a lump sum to be paid at that point, or for those beneficiaries to elect to move that pension into what's called an inherited pension or an inherited drawdown contract, which would allow the funds to continue to grow free of tax and for the recipient to draw on that pension as and when they want to. On death after 75, the rules are slightly different. Still quite tax advantageous, but not quite as advantageous as if somebody passed away before 75. Now, the majority of people will fall into this camp because average life expectancies are sort of between 85 and 87 at the minute, depending on when you're born. So most pension funds will be inherited in the event of death of a member after 75. And the rules that currently apply are that you still have the option to receive the funds as a lump sum or via this inherited drawdown contract, but the recipient or the beneficiary will pay their marginal rate of income tax on anything that they actually receive. So what we typically see currently is that beneficiaries would elect to go via or would elect to receive a benefit via inherited drawdown at that particular point in time, because it avoids a lump sum being paid to them directly and a large amount of money being subject to income tax in 1 year. So the inherited drawdown contract helps recipients control the amount of tax that's paid on a pension death benefit. It also confers other benefits because that recipient will then fill in their own nomination form and potentially be able to pass wealth on to whoever they want. And so what we see now is the rules facilitate the ability to cascade wealth through generations and generations and generations. And it's the date upon which the member dies that drives the tax treatment. So as things stand, pensions are a really tax efficient way to hold money and pass wealth on to future generations because they're not subject to inheritance tax, and because prior to 75 or death before 75, the benefits are inherited effectively tax-free, and after 75, recipients can more or less just step into your shoes and draw a taxable income as and when they want to, and then leave funds to their loved ones. So how will this change? So in October 2024, we got the first budget of the new government, and they looked at various inheritance tax rules and how they could sort of, I guess, increase the tax take. So what we saw is the rules announced whereby pensions from the 6th of April 2027 will become part of the estate for inheritance tax. So before we take a step forward, I'm going to take a step back and just explain what inheritance tax is for those of you that don't know. When somebody passes away, all of the assets that they own, whether that's a property, a rental property, cash, investments, they're all totted up, and you get to a total, and then potentially inheritance tax at 40% is due on that total. We do have allowances that we can use to reduce that liability. So we have a nil rate band of £325,000 each. So no tax is due on an estate of up to that amount. And we also have what's called a residence nil rate band of £175,000 each. So in effect, most people, the majority of people, can have estates worth around about £500,000 before inheritance tax is due. And those allowances are transferable between spouses, but often they're taken up on second death by the value of properties, and actually typically these days pensions can add to that total, and so we would see values work beyond those allowances quite often. So what does that mean for these changes? So effectively pensions now are part of that pot. Prior to April 2027, they're not. They can still be passed to whoever you want to pass them to, so there's still flexibility in who will inherit. However, you can only pass your pension without any tax liability to your spouse, civil partner, or charity without there being potentially an inheritance tax charge. So how does that interact with the rules as they are today? So on death before 75, what will happen is an assessment of value of the estate. And if all inheritance tax allowances are used up by other allowances, potentially your pension will suffer inheritance tax at 40%. And it is the net fund that would then be passed to your nominated recipients, either via a lump sum or inherited drawdown, free of tax. So I guess in that situation, your worst case scenario is that there's no inheritance tax allowances available and the tax rate increases from nothing to 40. After 75, that's where the tax position for pensions becomes more problematic or more significant. And this is because of the interaction between the potential IHT liability on pensions and the fact that recipients of that net fund will then be subject to income tax at their marginal rate. So if we go back, if a member dies after 75 and there are no available inheritance tax allowances to offset against the value of your pension, then it will suffer inheritance tax at 40%. And then the net fund, so the fund after that tax has been deducted, can pass to your nominated beneficiaries, who will then subsequently pay 20% if they are a basic rate taxpayer, 40% if they're a higher rate taxpayer, and 45% if they're an additional rate taxpayer. The combination of those two taxes together mean that the effective rate of tax on a pension death benefit for a recipient paying basic rates is 52%. For a recipient paying higher rates of income tax, it's 64%. And for anyone that would subsequently pay additional rates of tax on that pension, the effective rate is 67%. That is a significantly higher tax rate than on any other asset suffering tax in the event of death. So the change is markedly different. And from an advice perspective, what it's meant is I, up until this point, have always told clients, well, since 2015, we've been telling clients that pensions are your most tax efficient place to hold money if you've got an inheritance tax liability because of the rules that are currently in play. That flips on its head from the 6th of April 2027. That's not the case anymore. So what the rules are effectively about are trying to incentivize people to spend their money during their lifetime rather than leave their pension to their beneficiaries in the event of death. It's really difficult to take in the impact without an example, I think. Sometimes when you just hear words and people talking at you, it doesn't compute. And so what I've tried to do in this slide, and it's entitled What a Difference a Day Makes, is to simply articulate what the impact might be using various assumptions. So in this particular example, we've got an estate with worth 3 million, split across property, pensions and investments equally. So a really simple calculation for ease of explanation. But the taxable estate pre-April 2027 is 2 million. And that's because this pension doesn't count. Doesn't mean to say there's no tax to pay. As I said, if death occurs after 75, income tax might apply if beneficiaries elect to draw income. But they can choose. They can choose to do that. So the point is that the taxable estate is 2 million, not 3. There is an available nil rate band here. So we're assuming a single person, not a married couple. So you've got £325,000, which is one full nil rate band. And In this particular example, whilst the client is single, they do have children, so they can use the residence nil rate band at £175,000 to help offset some of the tax that is potentially due on their main residence. So the combination of those allowances and the deduction of the pension value from the gross estate means that the amount that comes into charge for inheritance tax purposes is 1.5 million. At a tax rate of 40,000, that equates to a bill of 600,000. That's 20% of the gross estate, and that's the rules as they are today. What a difference a day makes. So what does it look like after April 2027? Now you can see here that the taxable estate has increased from 2 million to 3 million, and that is because the pension is included within the estate for the purpose of calculating inheritance tax. The available nil rate band is still there, and that's because everybody gets an available nil rate band, but not everyone has a residence nil rate band. That's an allowance that's tapered away once estates for single people hit £2 million. And so for every £2 over that amount, that allowance is reduced by £1. So with an estate of 3 million, it means that the relief is reduced to nothing. In fact, for an estate of 2.4 million, it would be reduced to nothing. So the combination of those two things, and it's the pension, by the way, the addition of the pension to the gross estate and the inclusion of the pension in that calculation that has resulted in the loss of the residence nil rate band. So the combination of those two things has meant that the amount that comes into charge has increased from 1.5 million to 2.67 million. The inheritance tax, therefore, at 40% has increased from 600 to 1,070,000, an increase of £470,000 that would have otherwise have been paid to your beneficiaries. On a percentage basis, that means that the overall tax take has increased from 20% to 35.67%. So that is significant. So from our perspective, what we're telling clients here is that what this isn't really about is really high tax rates in the event of death. What the policy decision is about incentivizing the right behaviour. So there are a lot of tax breaks, which I'll come on to in a second, when we put money into a pension. And what the government the reason for that is that the government want you to use pensions to secure your retirement, but not anything else. That's the reason for those generous tax breaks. And so anything that's left, in their eyes, is potentially subject to tax. So what this does is it means that it's incentivizing people to spend money now using their pension, and that will increase tax receipts immediately. So whilst these changes, it's taken them 3 years to come into effect, more or less, what it will have done is incentivize people to start drawing taxable income from pensions, and that should have had an immediate impact on tax receipts. Now, you'd be forgiven. We always focus on pension death benefits because inheritance tax is something that does concern people. But actually, so I don't want this presentation to be something that people to go away from this pension thinking that pensions aren't a valuable tool. They absolutely are, just not. They're not a mechanism to deliver value to people in the event of death. We've established that. But their purpose and role is to help support people's retirement. And they are the most tax efficient, cost effective way of saving in the long term. And what I want to do is try and show you the positive and some of the tax legislation that hasn't changed. So the positive is that pension contributions are so heavily subsidised, it really, really helps assist people build up a long-term pot of capital that they're able to draw on in retirement and fund their life. And that's so important because we will start to see people in retirement as long as they've been in work, because life expectancies are increasing. So let's see how this works in practice. So if a basic rate taxpayer that is employed makes a personal pension contribution, they can transfer £8,000 from their bank account into their pension, and the government will give them to gross that investment up to 10,000. So it costs you 8,000 to invest 10. For a higher rate taxpayer, the impact is more significant because they pay more in terms of income tax and you get relief at your marginal rate. So the same thing would happen. You would transfer £8,000, £2,000 would be added to your investment within the pension by the government, and then you would put the gross pension contribution on your self-assessment, and the government would give you £2,000 back in higher rate relief. For additional rate taxpayers, that amount's increased to 2.5. So the total relief for a higher rate taxpayer is 40%, total relief for an additional rate taxpayer 45%. But it's the net cost that's powerful here. The net cost is between 5.5 and 8,000 just to make a £10,000 pension contribution. The government want you to be financially independent in retirement. Now, the relief is still as powerful for business owners because pension contributions are a really efficient way of extracting value from your company by comparison to salary and dividends. So if you were to make a £10,000 pension contribution, that would sit as an expense in your profit and loss. And for most businesses, that would then mean that you get corporation tax relief on 25%, at 25%. And what you're effectively doing is moving it from one asset that you own into another asset that you own, and you're going to use this asset in the longer term. And while funds are invested in pensions, they grow free of capital gains tax and income tax. So that's a really, really efficient way to save. And that in itself assists the compounding impact. Compounding is basically growth on growth. It's probably another topic for another webinar. So what should you consider going forward? So when we're specifically looking at pensions, and maybe something that you can take away and do for free, is that if it was me, I would be looking at my nomination form. So your wills for your pensions that I referred to earlier. Many people who have wealth in pensions that they're probably not going to need may have nominated their children, and that might not be appropriate going forward because it might create a situation where children immediately are subject to inheritance tax unnecessarily, and that's particularly the case for those clients that are over 75. So review your nominations. It might be that a redirection to a spouse is more appropriate. Think about where your pensions are held, and I can't tell you how important this is because I've personally reviewed many pensions that don't offer inherited drawdown as a death benefit option. So if the only option is to pay a lump sum on death, and some pensions are contractually written that way, you don't have the full flexibilities that the rules allow. And that again can create unnecessary tax charges, particularly after 75, because what it would mean is that there's potentially inheritance tax and there's almost certainly going to be income tax, probably at higher and additional rates, whereas that might not have been the case had things been inherited via an inherited drawdown contract. Please don't transfer any pensions without seeking advice first, because those very same pensions that were written under very old rules might confer other safeguarded benefits. And so you really need to weigh up the pros and cons of moving. Some offer guaranteed annuity rates, some offer enhancements to tax-free cash, some offer guaranteed growth rates. The list could go on. So I'm not for a second suggesting that you take action on that, but just review it and try and establish whether you need to take that conversation further forward. And then I guess the next action is quite simple. Figure out what your notional IHT liability is now, what the impact might be post April 2027, and what action do you want to take to reduce that. And whilst I've not touched on it in this presentation, if you do own a business, there are changes coming in from this April that basically affect the ability to transfer that business without any tax to your family or whoever it is that you want to inherit. So the limit on business relief, which is a relief that allows you to pass wealth on to future generations or whoever you want without tax deduction, is now at 2.5 million. per person and it will be transferred between spouses. So if you own a business, the simple message is these changes announced in October 2024 could be far more wide reaching than anything I've discussed in earlier in the presentation. And I would suggest that you actively seek some advice. Nigel at Langricks offers really cost-effective reviews, and yeah, as I say, it'd just be like getting a survey at a point where the rules and the landscape have so significantly changed. If you do decide that the tax take is likely to be unacceptable to you and you want to do something about it, then generally speaking, the strategies fall within 3 categories. And most people would employ a combination of those 3. So you can spend the money, the most enjoyable way of inheritance tax planning, I guess, but not everyone has the capacity to spend everything in their lifetime, and that's a lovely position to be in, but it is a reality for some. You can then gift some of the money away, and you can use some of the exemptions that are ignored for inheritance tax purposes, like the £3,000 exemption, like gifting out of regular surplus income habitually. That's a nice way of moving money from a pension environment that's in your name into a pension environment that's in your children's. And that the frictional costs of that can often be very little. Nigel would talk you through some trust options or just some outright gifts. And then you can insure it. If you don't want to gift away capital and you don't want to spend, and you can't spend all of it, you can insure your liability, which is basically a mechanism to fund it. And an insurance policy equal to your notional inheritance tax liability can be put in place so that the cash is available to pay the bill on death. And that cash is really quickly received. And so this particular option is really attractive to, as I say, people that don't want to give away capital for various reasons, but it's also really attractive for people who have less liquid assets in their estate, like property, which take time to sell, because there is limitations on how long we can wait before inheritance tax is due, and often that payment is due before we can liquidate assets to fund it. So I'm just conscious of time. I know I'm slightly over there. I want to thank you all for joining me this afternoon. And if you do have any questions, please get in touch. I'll hand over to Fern now for a little bit of housekeeping.
Thank you so much, Becky. I found that so interesting. That's the second time I've heard it now, and definitely lots more topics that we could talk about from there. So keep an eye on your emails, because we will be doing more webinars with Becky as time goes on. But if anyone has any questions today, or they'd like to speak to Becky or Nigel, I will send out a follow-up email after this webinar with the link to the webinar if you want to watch it again or share it with anyone. So that you can then get in touch with them directly. So thank you so much. Thank you, Becky. That was really informative, and hope to see you all on our next webinar.